What's up? What's up? What's up? My mind your money business folks. This here seems to be a little too bright or not enough light. Oop, I clicked the wrong button. I don't like that light either. Hold on for a second. Okay, that is a little better, except there's a little glare on my forehead. Hey, we just gonna have to make do with this because I have to get off to work. It is Tuesday morning my time, but Monday morning on the um, East Coast, where the stock market just closed, and the S&P 500 rises, to a record high to close out Monday. Pretty much, they're saying traders are extending the Fed cut relief, and it's still a rally happening. So let's get into this article. And also, I want to talk about at the end on what you need to be doing in order to take advantage of the stock market at this present time and moving forward, right? Because this is a long-term thing. If you're looking for short-term money and goals, I mean, you can be in it for the short term, like day traders are. But what I'm talking about and what I'm attempting to do is for the long run, for the next 10, 15, 20 years, But let's get into this article before I talk too much. It says the U.S. stocks rose Monday as Dow Jones Industrial Average and the S&P 500 eked out record closes, extending a winning streak on Wall Street. If you have been investing your money, you should be up in your money market account and your 401ks, so on and so forth. Investors look to Federal Reserve speakers and the key inflation reading for clues to the odds of another big rate cuts. Remember, the Feds are meeting again next month. No, not next month. In November, and then again in December. And there may be more rate cuts to come this year. Who knows? Okay, the Dow Jones rose more than 0.1% after closing at an all-time high on Friday. Okay, the S&P 500 edged up more than 0.2% to finish at its own record. The heavy tech NASDAQ composite climbed 0.1%. That's why you need to be investing, people. You have to invest. That's why I want to talk shortly after talking about the stock market on what you need to be doing. The market is laboring with concerns about the health of the U.S. economy, which have persisted after the Fed's bold pivot to cutting interest rates last week. Again, the problem with last week, well, not the problem, they were talking about a 25 basis point cut, and the Feds came out with a 50 basis point cut, which threw people off. It threw big investors off. But 50 basis point cut is a good cut nonetheless. The big question now is whether upcoming data releases this week will support Fed Chair Jerome Powell's assertion that conditions remain strong. Okay, much will depend on Friday's reading on the PCE index, the Fed's preferred inflation gauge, and Thursday's second quarter GDP print. Again, you have to pay attention to these reports that are coming out, the PCE index and the GDP report that's coming out. These reports affect the stock market. That's why you, as an investor, need to be aware of these reports and how it may or may not affect your investments. Okay, experts believe that cooling inflation, not a rising risk of recession, will give policymakers the green light for another 0.5% cut this year. So if we get another 50 basis point cut this year, that'll be great. Meaning when they get together in November, they can come out with a 25 basis point cut, and then again in December can be another 25 basis point cut, equaling out 50 basis point, 0.5%. Again, and that will be a whole 1% basis cut this year. Okay. Investors received more policy insight from the Fed officials on Monday morning, Rachel Bostick and Neil Kashkari explained why they were in favor of reducing interest rates by a jumbo 50 basis point instead of a smaller first cut, citing progress on inflation and a cooling job market. Again, interest rates being cut allows everyone to borrow money at a cheaper rate. Companies can go to banks and start borrowing money at a cheaper rate in order to grow. Consumers like you and I can go to banks and borrow money at a cheaper rate to purchase houses, to purchase cars, so on and so forth. And when we're purchasing these items, we're putting money back into the economy. All right. Okay. Given the rare lack of anonymity in the last decision, remarks from Powell and dissenting Fed Governor Michelle Bowman later in the week are likely to be closely scrutinized. So pay attention to these reports, people. Pay attention. Follow the money. Mind your money business. Mind your business. Don't get too involved in things that do not concern you. Mind your business. Mind your money. Make sure that you're investing your money where it needs to be invested in order to create passive income. Have your money making money, protection. You're protecting yourself. You're blessing yourself. You're setting up and creating a foundation for you and your family to maintain a solid foundation, money that can be passed on for generation to generation. And the sooner you start, the better. Right. Among Monday movers, Tesla stock rose on a bullish delivery forecast from Wall Street ahead of the EV maker's robotaxi day in October. Intel shares also jumped after Apollo Global Management reportedly offered to make multi-billion-dollar investment in the struggling chip maker, a vote of confidence in its turnaround strategy. And that is it for today. So let's look at Tesla. Tesla rose. I have some Tesla stocks. Tesla rose today $11.75. That's major. That's good. What if you had thousands of shares of this stock? You would have made a lot of money. NVIDIA today rose 26 cents. I'll take that. I have some NVIDIA stock. I'll take the 26 cents. No, because my portfolio was green today. Okay, Apple. Apple went down $1.73 today. Okay. VTSAX. Is this today? Went down 34 cents today. Okay. Microsoft went down $1.76 today. FTEC, Information Technology Index ETF, went down 21 cents today. SPLG, the S&P 500 ETF, rose 18 cents today. I'll take that. Broadcom, ticker symbol AVGO, went up $1.84 today. Not bad. So that's all I want to cover. Now, what I want to talk about, what should you do? What you need to do when you're making the decision to invest into the stock market, when you're choosing to create an individual IRA for retirement or invest into your company's 401k plan, you need to come up with a plan. What you need to do is create a plan. I was having a conversation this morning with someone, and this came up. Where there is no vision, the people perish. You don't have to be religious, but that is really true. When you have no plan for your life and where you would like to go and where you plan to go, what's going to happen for you? Who's creating building that foundation for you for the future, for passive income? Because as we get older, the less and less we're more than likely willing and wanting to work. So when you're not working for your income, how do you expect to maintain the lifestyle that you've created for yourself? Or is it possible to create even a better lifestyle when you retire? And the answer to both of those is yes, you can create a better lifestyle, and you can also maintain your current lifestyle, right? And you can do that by investing into paper assets or investing into assets as a whole, like real estate, the S&P 500, so on and so forth. And also what I would advise people to do is when you're new to investing or just investing period, you need to diversify your portfolio. Not investing all of your money into one individual stock is a very smart thing to do. Diversify your money. Having your money invested into, say, an S&P 500, the S&P 500, say that one S&P 500 ETF, which is SPLG. Let's look at that as one single stock. But within that one single stock, it's packaged 500 of the biggest and largest companies in the United States is packaged within that one little stock that's costing now, as of today, $67. I look at that as a safe fund to invest in because your money is not invested just in Amazon, that one stock, or it's not invested into just Microsoft. You're not having 100% of your money invested into one stock, but investing into a S&P 500 index fund, exchange traded fund, or mutual fund. Let's just use SPLG, index exchange traded fund, as an example. Investing all of your money into SPLG, your money is being distributed amongst those 500 companies whenever you buy one share of that ETF, ticker symbol SPLG, which is one that I buy, right? And year to date, let's go to year to date returns. I've talked about this on many occasions. Year to date's return on SPLG is 20.75%. You've gotten 20.75% return on your money, right? Which is great. So you could go to Google and type in, what is the standard rate of return of the S&P 500? Hit enter. And it says the average yearly return of the S&P 500 over the last 100 years as of the end of December of 2024 is 10.628%. The average rate of return, again, of an S&P 500 is 10.628% over the last 100 years as of July of 2024. You can research this information, right? And this assumes dividends are reinvested. Dividends account for 40% of the total gains because understanding dividends, you need to understand dividends. And let's say you don't understand what dividends are. You can go to Google, what are dividends? Boom, right there, opens up. A dividend is a distribution of profits by a corporation to its shareholders. When you own Starbucks stocks or when you own the S&P 500, and the 500 largest companies that consist of the S&P 500, Intel, Palantir, NVIDIA, Microsoft, Tesla, you own those stocks. And those corporations pay out what we call, not all of them, but some of them pay out what we call dividends. And dividends is a distribution of profits. These are the profits that the companies pay out to its shareholders like us, those of us that own the stock. The stock market was created to make money. And make money is what the stock market does when you invest your money smartly, right? So what you can do, you can also go to this thing called the future value calculator. Type it in Google. Comes up. And let's say you're willing to invest for 15 more years. Let's say 15 years. Your starting amount, let's say you started out investing $5,000. The average rate of return, like we just read, 10.628. Oh, can we put 10.628? And periodic deposits, let's say you want to put in $2,000 a month, $24,000 a year, and hit calculate. In 15 years, if you start out with $5,000, let's say you don't start out with $5,000. Let's make it more simple. Let's say you just started with $500. And then afterwards, after you put $500 in your stockbroker's account, and then you start investing $2,000 a month into, your S&P 500 ETF, exchange traded fund or index fund, choose one, right? In 15 years, you can have $803,846.88. Let's say you started out at the age of 26 and you want to be done by 36. I mean, not 36, but 56. That's 30 years. And let's say you just continue to do that. You started at $500 because I'm going to show you how the sooner you start, the better. The more you can start teaching this to your kids, the better. So this is what you need to be doing. The sooner you start, the better. If you're older, just get started. It's better to get started and create something than nothing at all, right? So then say you started at 26, or your child starts at 26, you start them out at 26, and then they continue to do it for 30 years till the age of 56. They started out with $500. Then at 10.68%, 628% is the interest rate. And then they $2,000 a month, calculate 30 years, right? From the time you or your child was age 26, all they did was invest $2,000 a month for 30 years. They would have $4,458,776.55. That's how it works, people. Compound interest, that 10% that's being added each year, the more and more your money continue to stack, and the more you continue to dollar cost average in for long term. I'm into the stock market for the long term. I'm not trying to be a day trader. I'm not trying to pick the right stock at the right time to make the most money. I find good growth stocks or ETFs, exchange traded funds, mutual funds with a return like SPLG, the S&P 500, that I just read to you, and you can also do your own research, because I'm not an expert. I need to make that clear. I am not an expert. I'm just someone online providing my opinion and what I have learned throughout the years, and that you can do as well, right? If you would like to, verify what I'm saying, talk to an expert, find a financial advisor or planner in your area, schedule an appointment with those individuals and talk to them, right? So again, $4 million. 4 million. Let's say you don't have 30 years, right? You want to do this again. Let's just say you want to do this in the next 10 years, and you're starting out with I don't know, let's say $150,000, right? Let's say, I don't know, you own a company, you have $150,000 in your SEP IRA, and within your SEP IRA, you're investing your money into an S&P 500. History says you're getting at least 10% return, and then you're investing, let's say, $72,000 a year, $6,000 a month, because it's like you're making big profits off of your company, so on and so forth. So you want to do this in 10 years. Let's see how much you will have in 10 years. Check this out. Even though, I want to show you the difference. Even though you're starting out with $150,000 in your investment account, but you're doing it for 10 years because you're older now, you're 50 or you're 60 and you want to do it till age 70, or you're 55 and you want to do it until you turn 65, and then that's when you start collecting Social Security. So 10-year period, $150,000 starting out, and putting $6,000 a month, you will have $1,594,476.61. That's great and all, but again, you will only have $1,594,476.61 compared to that person that started out at age 26. You're now 55 and you only want to invest until the age of 65, because now you can't afford, or you don't want to, have your money in a fluctuating market that is topsy-turvy throughout the year during your retirement age. You want your money now parked in a secure place where you don't have to worry about losing that money, right? But I will say that $1,594,476.61 is better than nothing, right? At all. But you can see the difference in long haul and short term. But this is what you can do. And you can play with these numbers. And this is what you need to do. You need to create a plan, develop a plan for your situation and for your life. Again, where there is no vision, the people perish. You have to create a plan for your life. Don't expect someone else to plan your life for you. Even if you do find a financial advisor, ensure that you're meeting with that advisor. Ensure that you're paying attention to your monthly statements and seeing your money being invested into the things that you agreed upon, and that you're getting the returns that you want and you discussed. If not, you hold that individual accountable. But for me, I'm just doing this on my own because I learned a lot during COVID, and I started investing in the stock market. I max out my company's 401k, and then I take my other surplus of money and I invest it into the stock market. I also lowered my debt to income ratio by getting rid of all of my debt. I have no debt, no mortgage, personal loans, no college loans, no credit card, nothing. So you need to also lower, what you need to do is also lower your debt to income ratio. You need to get out of debt, people. You need to get out of debt. You got to get out of debt, right? Because the more debt you have, the less money you have to send out to work for you. When you have debt, you don't control your finances. Whomever you owe money to controls your finances. You're working to pay whomever it is, Sally Mae, Ford, Dodge, Mercedes, Lexus, Hilton Farms, Credit Union. Like Dave Ramsey said, when you're in debt, you are a slave to the lender. Even family members, you are a slave to those individuals until you pay off that debt. And I like having my freedom. And you can gain your freedom by ensuring that you don't go into debt or stay out of debt. So those are things that you need to do. Or that is the thing you need to do. Create a plan. You need to create a plan, people. Create a plan. Create a plan. Create a vision for your life and where you want it to go. And start only thinking about that from here on out. Stop paying attention to the news, who's doing what, who said what, who's going where, who's buying what, who said what. What are you saying? What are you doing? What are you planning? What are you investing in? Worry about you. Mind your money business. All right. So on that note, I'm going to end it. You guys take care because I got to get off to work. All right. Peace. Uh-oh. End.